Welcome to a new episode of Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. This, of course, is a podcast that will make you a much smarter investor. Before we get to our feature interview for this episode, have to start on our stock of the day. And it's an ugly story, so cover your eyes, folks. It is Target. Shares are getting absolutely blasted. As I am taping this right now, stock is down over 20%. Company missed on earnings, missed on sales, and absolutely obliterated its full year guidance. This after 3 months ago saying a turnaround was afoot. Here are three things that I saw wrong in this quarter. First up, company's inventory grew at a faster pace than sales. I know you're saying, Soz, that's really wonky. Who gives a damn about that stuff? But for a retailer, that matters. You want to see sales outpacing the inventory you have on the sales floor. You'll probably see more discounts from Target in the holiday season. Clear that inventory, pressure margins. Number two, weakness in discretionary categories like home goods. Why that bothers me is because other retailers are starting to show strength in discretionary categories of late. Not a lot of strength, but some strength. To see Target not showing that strength, to me, is a red flag. And then last but not least, the tone. It's hard to pick up on this on an earnings release, but I got to talk to Target CEO Brian Cornell a little bit and his executive team a little bit on these results. Sounded cautious on the state of the consumer and how that may play out for the holiday season. Did not like to hear that. Did note, though, Cornell said the holiday season is off to a good start, but also called out that a lot more big weeks are ahead. Again, Target not looking good here. Also in the context, big quarter out of Walmart this week. Another big quarter. Same-store sales for them up 5.2%. Target same-store sales up 0.3%. Walmart just gaining market share. All right, I could talk all day about Target, but I do not want to because there's another big company we have to drill into, and that is Nvidia. And for that chat, we got Jeff Jacobson, head of derivative strategy at 22V Research. Jeff, welcome. First time on Yahoo Finance, right?
First time. Great to be here. Thank you.
Hell yeah. Thanks for coming down here to the NASDAQ market site. Love your team's research, and I love the note you put out on Nvidia. And I liked it because it was just complex, and it was just like cool stuff. So take us through how someone like you and your background, how do you approach an Nvidia earnings day?
Sure. First we'll start with the Nvidia itself. Implied move tonight on earnings is about 8.25%, which on the surface you look at it and say, okay, it's Nvidia 8.25. It seems pretty fair. I look back the last 5 quarters, the average move was 7%, so 8% justified. However, a little digger, deep into those numbers, 2 of those quarters, you had a 16% jump in February when the stock was 67. The stock's now 147. You had a big jump in May when the stock was 95, and now again 147. So it's going to be a lot harder when you have the 120% gain since February, the 55% gain since May, to get that type of move on the number. Not to mention, at a 3.6 trillion market cap
that
now.
Number's huge.
Yeah, versus again back in February, the market cap was closer to call it 1.5 trillion in May. So the law of numbers starts to work against it. Now, I'm not saying that the stock can't have another big move, but when you have a 3.6 trillion dollar stock and you've had the success that the stock has had year to date, it just gets harder and harder to keep kind of getting higher, especially when the bar is raised where it's been.
So you're sitting at your desk. How do you approach Nvidia? Because I think a lot of folks, when they go to Yahoo Finance, they see Nvidia, they'll look at P ratios, they'll look at multiples, they'll study earnings and profit trends. But I imagine, given your trading background, you approach it a different way. Like, what screens do you set up? Like, what does that look like?
Yeah, I mean, I look at volatility for, that's my go-to, and kind of, like I said, I'll look at the implied move first. I'll look at what the stock has done in the past, and then I'll look at not just where the weekly vol, the at-the-money straddle, that's again 8.25% move, but I'll look at further months as well. And then from there, I'll kind of dictate, to myself, what's the best trade. So that being said, I'm kind of not in favor of buying expensive weekly vol here, again, just because of the size of the company. It's getting harder to move. Unless you really think it's going to have a dive, you probably want to stay away from expensive vol. So I'll look at December vol, I'll look at January, and I'll see what stands out to me the most. And after doing that, if we're looking at Nvidia itself, I think that buying vol in December or January, depending on the viewpoint and how you want to play it, makes a lot more sense. Typically, the December and January vol is trading about around 45.50. That's in line with realized vol. So typically what happens on an earnings event is the earnings come out and volatility collapses down to where realized vol is. Well, you have realized vol trading in Nvidia, the 30-day and 60-day vol, pretty close to where January and December are. So I don't think we're going to see that huge vol contraction that you would see if you bought the weekly options and then the vol collapses.
Are you a big chart guy? And I ask that because if you go back and look at Nvidia's chart, at least on Yahoo Finance, let's say 6 months, I mean, the stock hasn't moved a lot since, what, late summer? Like,
Yeah.
What does that tell you?
I mean, yes, it hasn't moved a lot, typical for the move everyone expected Nvidia, which was, just gain after gain. But I think that draws me into one of my ideas. We'll get to that in terms of the SMH. When you look at the entire semiconductor complex, that's really been, down.
It's been down.
Decimated.
I mean, you look at AMD, you look at, I think it was Qualcomm, all these AMD's really been hit.
The semiconductor equipment companies,
Yep.
AMAT last week got hit pretty hard on earnings. So I think the strength in Nvidia trading basically at the highs is masking some of the real weakness we've seen. Now you can argue Nvidia AI play, the other companies are more levered to industrial, the phones, computers, what have you. But because Nvidia is such a high weighting in the SMH, it's really masking, I think, the weakness that we've seen from other parts of that group.
Then does an Nvidia investor, these people, we talk to these folks all the time, they love Nvidia. They are obsessed with Nvidia. I mean, the stock has made them a ton of money the past 5 years, even the past year. Should they be taking more of their cue right now from the weakness in semiconductors more broadly? What I'm trying to get to is semiconductors suggesting something brewing for Nvidia?
Yes, but the argument that I think the bulls will have is say, well, it's a different industry, the AI growth, the capital spending that we're seeing from the major companies. So maybe we are seeing that spread between Nvidia and the rest of the complex is deserved because of the growth and the money going there. Not to mention, probably as we see weakness in some of those other semiconductor names, the money will funnel towards what's working, which is basically Nvidia in that space. So I think it's going to be more of an if-then. We'll see how the earnings play out. If the earnings disappoint our guidance or the expectations are too high, then the bears will say, see, the other semiconductor stocks were signaling that. And if it's bullish, then the bulls will argue, see, where we shouldn't be kind of grouped in that same category, which is why the earnings, again, are always important.
You laid out 3 trades. To me, they're complex. I mean, let's go through them tick by tick. Trade number 1, and to the extent you could you put them in a little more simpler terms?
Sure. So let's get back to the semiconductor ETF, which is the SMH. It's about a 23-24% weighting in Nvidia. And like I said, I think the strength in Nvidia is masking the weakness we've seen underneath. And yesterday was a perfect example. Nvidia was up 5% yesterday. The SMH was barely up 1%. With a 24% weighting, that means that the other 24 names in the SMH were essentially flat to down. And that was a day with Nvidia up 5% and the NASDAQ up about 70 basis points. So there is real weakness underneath the hood here. So how I approached it is into earnings, you have exposure in SMH, Nvidia, 24% is probably the largest weighting of any liquid ETF to get exposure into Nvidia. So the trade that I like is to set up a put spread collar. In its simplest terms is you're selling a call in SMH in December.
Call option.
Selling a call at a, let's call it 260, 265 level. That's basically been the high in the last few months for SMH. And you're buying a put spread, I believe it was a 235, 210 put spread in December. And why I like this trade is, yesterday was a perfect example. If Nvidia has a good report and it rallies, I don't think you're going to lift the rest of the complex up, just like yesterday. So to get to that strike on the short call that you're selling, it's probably going to be very difficult. You're going to just need a massive move in Nvidia to get to that level. Now, conversely, if Nvidia disappoints, it's probably going to reinforce the weakness we've seen in the other semi names. So, and not to mention, you have a 24% weighting in Nvidia. So if Nvidia is down 10%, you probably have a 2.5% move just on the Nvidia component, SMH, plus weakness in the rest of the group. So why I like that too is you're financing about more than 50% of the put spread of that trade by selling that upside call that I think is going to be really hard for SMH to get to. So it's a way to play Nvidia without playing the stock Nvidia directly. And I like that setup. Again, large exposure, selling a call that I think is very unlikely to come into play, even if Nvidia does well. And if Nvidia should sell off, I think this trade, the structure will serve you very well.
Is there an address our audience can send money? Because you're giving good insight and it's all free. Thank you. Yeah, you're welcome.
Yeah.
You're welcome. Listen to the Opening Bid podcast more often. I mean, this is stuff, this is great. I'd eat this up. Trade number 2.
So again, along those lines, trade number 2, I try to identify when you have a name like Nvidia, I try to look at the liquid ETFs that trade options that have high weightings in Nvidia. So XLK, and I know everyone normally thinks QQQ when they think NASDAQ and tech, but XLK is also another liquid ETF. The main difference is that you get a 14% weighting in Nvidia. The Qs have about an 8% weighting. So you're getting nearly double the weighting. The vol's a little more expensive, but I think justified because again, you're getting double the weighting in Nvidia ahead of earnings. So I like playing that by buying just a put spread. I don't think it's justified to sell a call because the vol isn't as expensive as I saw in SMH, and the dynamics are a little different. So you get 14% exposure to Nvidia, and I think the other big part, which I pointed out in my piece, is you have 2 other large cap names, Apple and Microsoft, that have heavy weightings. Combined, they're about 27%.
Both have been lagging?
Both have been very much lagging, and probably weakness in Nvidia will weigh on them just because of the tech trade and whatnot. So I like buying a December put spread in XLK. Again, not playing the weeklies, not trying to game it that much, but because you get the large exposure in Nvidia, because Apple and Microsoft have been lagging, neither of one have made a new high when the market did. You get the, obviously with Apple, the China headlines, it goes out to December. So buying the put spread, I believe it was a 225, 205 put spread. That's about a little less than $3 now. You're getting a 6-to-1 payout on that with the Nvidia earnings tonight, which could be a catalyst for weakness if it disappoints. Apple and Microsoft heavy exposure. And another key point is there's no Tesla weighting, and I believe no Amazon weighting. Those are 2 of the stocks that have really lifted and held the market up on the tech side. So I like having kind of that focused exposure in 3 names at about 40% that could work to the downside. And that's what you want on your hedges.
Hold on to trade number 3. We're going to go off for a quick break. We'll be right back on Opening Bid. All right, welcome back to Opening Bid. Having a fascinating chat on all things Nvidia ahead of the company's earnings with Jeff Jacobson, head of derivative strategy at 22V Research. I just love the complexity of these trades. I think it reminds me that, yes, I do know what I'm doing, even though I haven't like waded into these deep, complex waters in some time since I was an analyst many years ago. So trade number 3. Talk about trade number 3 on Nvidia. What are you seeing with this one?
I think there's other ways to play it. I mean, I think you can just look at owning some SPY puts. Vols come in. I think you're getting a decent amount of tech exposure, and why SPY is basically moved down to a level where owning vol makes sense. Pre-election, the SPY vol was trading around 23, and now you're looking at a vol closer to 13. It's risen a little bit the last few days. I think it's just as a market sentiment trade, I would just outright own SPY vol here. It's gotten cheap, and I think as a way to kind of macro hedge, certainly the tech component, a big part of it. So a way to get broad exposure at a cheaper level, whereas XLK is very focused on tech and trades at, call it like a 20, 21 vol. You can own S&P vol here about 13. You can just outright buy puts or a put spread here and get broad exposure to the market through December. The market's up 25% year to date. So owning vol or owning cheap protection here through the end of the year with Nvidia and now potentially more geopolitical risk, I think makes some sense.
Do you sleep the night before an Nvidia earnings? Like, I mean, do you get nervous about some of these calls? It's just like.
I think it's more excitement that, I mean, this is what everyone in the market wants. It's the action. It's trying to forecast it. My job is to look at purely the vol component and make an assessment. Is vol rich? Is vol cheap? One other trade, going back to Nvidia, I think.
Keep them coming. Yeah, this is great, man.
I wanted to point out, I mean, everyone loves Nvidia, and for good reason. It's probably been the main reason.
It's printed money. It's been like a CD, except this CD pays 30% every time it reports earnings.
Right. If you've owned it, you love it. An interesting dynamic, Nvidia, that I wanted to point out, not so much in the weeklies, but if you go out for longer, is upside calls are expensive to puts. Probably a function of some of the gains we've seen on earnings. Maybe it's a function of the FOMO of I don't want to miss the upside. Maybe you're seeing people sell some stock and buy calls as a replacement. Whatever the case is, I looked in December and the upside call in Nvidia is trading at a higher vol than the puts, meaning stock closed at 147 yesterday. As an example, the 160 calls, 13 points up, are trading at the same price as the 137 puts, 10 points down. So that's giving you an idea of the favorable skew, if that we call it, where calls are rich to puts. If you are nervous and you own it and you still want to have upside, but you want to have that downside protection, that's a really interesting trade because you still have some upside, almost 10%, if you sell that call against your stock and buy that protective put. And it trades for even. So the stock does nothing, there's no harm, no foul. If you get a move lower, then you have that protective put at 137. The stock was 138 on Monday morning. So we can see and have seen volatility. And it doesn't mean necessarily you need to even sell that 160 call. You could sell a higher strike call. It would trade for a debit. But again, knowing that calls are expensive to puts, stock's up a ton this year. It's at the highs. This is the weakness we saw in semiconductors. So that's another trade, speaking specifically on Nvidia, that I think as a collar or a protective collar, it's a really interesting setup.
I just got a mention in my ear from our fabulous producer. Can you define a put and call for the average investor?
Sure. So a put gives the buyer the right of the put to sell the stock at that price. So let's go back to the Nvidia trade. The 137 put means if the stock goes below 137, you get the right to sell the stock at 137. So if the stock goes to 125, you sell it at 137, you make the $12. And the call is just the opposite. It gives you the right to buy a stock if you own the call at a price. So if you bought the 160 call and the stock was trading above that, you effectively make all the money above the 160 strike that where Nvidia is trading. So you buy it, you're effectively buying a 160 call. At the stock trading 165, you effectively buying it, own it $5 cheaper. That's your profit.
Interesting. You do realize we're calling you back in 3 months on Nvidia earnings. So you gave us 4 trades. I'm making notes. Next thing we have to come back with like maybe 5. But you do other things besides track Nvidia.
Sure.
This has been we've seen obviously a major run up in stocks after the election. Like, what has history shown you about markets last 2 months of the year when you have the S&P 500 up 20% or more?
Yeah, I mean, I put a note about that. We looked at it. So in the last 10 years, you've had 4 years where the market's been up 20%. November, December tend to do well. I don't know if it's a function of the market's done well and maybe there's a tax reasoning why people don't want to sell. Maybe it's the window dressing, or maybe it's just the fact that the market's in a good place, the economy is in a good place. But generally, in years that the market's up more than 20%, like this year, November, December do well. There's certainly a seasonality to it as well. I think with vol, and that's kind of why I mentioned vol in the S&P. It's cheap here. I think owning it, whatever your viewpoint is, if you want to buy a cheap upside call, makes sense because the market could, let's say Nvidia, puts up a good number, it goes higher. Let's say rates kind of just stabilize and go down a little bit from here, as long as we don't get above 4.5, let's call it on the 10-year, probably have an upside bias bid to the market through year end. Again, X anything geopolitical that's not foreseen.
So we know, the market has traded up post-election, lots of, optimism around what incoming President Trump may do for the economy. But do you see a more defined catalyst for markets end of November, December that might lead to a melt up in markets, or conversely, something that might cause investors to take profits before year end?
I think it's all about rates here between now and the end of the year. We saw it to a degree. The 10-year got to 4.5% on Friday, and it stopped there. I think if we get above 4.5%, and whether it's driven on inflation fears or policy, what have you, I think a move above 4.5% will kind of trigger somewhat of a risk off in equities. As long as we stay in this range, call it between 4.5%, I think the market's fine with that, and we can see continued strength in the market. But I'm certainly watching rates. I know that our firm is, and looking at what is a magical level where the 10-year gets above that will definitely trigger more of a risk-off mentality. I think short of that, because of the upside bias, because the market's up year to date, 25% or so, that the market should hold in and do fine here. But I think if yields start to become a headwind, certainly in the more of the riskier asset classes in the market, anything obviously yield sensitive, whether it be home builders, utilities, defensives.
If let's say yields stay consistent, we don't see any wild moves
right
there. Is there an appetite to push stocks up aggressively into year end, or do you think it is more of one more slow grind higher?
I would think it's probably more of a slow grind because we've seen winners and losers. Like you mentioned, we have winners in Walmart, we have losers in Target. There's enough sectors doing well and some that are poorly. Semiconductors is a perfect example. In general, the semiconductors are doing poorly, yet the NASDAQ is pretty much at the high. So there's not everything is working right now. So there's probably not enough to see just a melt up, but I think a grind higher if it's the sectors that are heavily weighted enough, or more specifically, the large cap names, the Nvidias, the Amazons, now Tesla, that are kind of doing a lot of the lifting, as well as you have other sectors doing well, certainly the financials and industrials and sectors like that. So I'd be more in the camp of a grind, as kind of more of a grind into year end than just a melt up, because right now it doesn't seem like everything is working together.
I always want to make sure investors are prepared. Let's say Nvidia comes out, they're going to put out a good quarter, but some people that I've talked to suggest they may not blow it away on guidance. Guidance will be good, but given the demand around Blackwell maybe being more stronger next year, if there's a disappointment anywhere in this report, like what does it mean to the broader stock market?
Yeah, that's getting back to my point. Certainly Nvidia is a major catalyst for the broader market as well. Now, we've seen situations where if tech doesn't work, the money rotates to other areas of the market. So maybe you see, on a tech weakness, as long as rates stay here, maybe that helps propel the small caps. That probably helps propel more of the financials. It feels like money is not really leaving the market. It's just this rotational game, right? So if money starts to come out of large cap tech, the question likely is going to be, well, what sectors are going to benefit from that rotation? And again, I think it's probably going to be more what's working, which are financials, industrials, small caps, as long as rates stay here or lower.
The last part of opening, we always love to ask our guests their hot takes. Wherever you want to go, your hot take on markets next year, your hot takes on what the markets have done this year, just have at it.
I think it's more of the same. Speaking in my world, I think it's just watching vol. Vol, you want to own it when it's cheap. That's been a theme, on the market, especially to the upside. If you can own cheap calls on the market that tends to be going up, then you want to do it. When vol on the upside calls, a 1 month calls is trading at a 10 or 11. We like buying them. It gives you flexibility. I tell clients, if you own an upside call at an 11 vol and the market gets there, it gives you the flexibility. Maybe you want to lighten up on some of your core holdings. Maybe you want to monetize the upside call. So, I think you just want to basically thematically want to own vol when it gets cheap. Think of it as insurance. Certainly on the put side for owning market protection, but even on the upside, I think people generally think that owning options is just about playing the downside. Well, calls tend to trade cheap to puts. The market tends to go up, so when you get these pullbacks and you can buy relatively cheap upside calls, it just makes a lot of sense.
I haven't done this before, but I'm going to give a quick hot take of my own. That quarter from Target was really not good, and I need to see Target. I need to see them selling more fresh food. Sell fresh food. I go into Target and I could get some fresh food, but when I walk into Walmart, they have deli slicing counters. They're selling fresh bread. I need to see more fresh food at Target. I had to share that with you, Jeff. I needed to get off my chest. It's been a long week.
I appreciate it.
All right, Jeff Jacobson, good to see you here, head of derivative strategy at 22V Research. Tell the team over there we said hi. They were early supporters of Yahoo Finance, and we'll talk to them soon.
Will do. Thank you.
All right, appreciate it. And that's it for the latest episode of Opening Bid. Hit us with those 5 stars on Spotify, thumbs up and likes on YouTube, and just keep on showing us that love. We feel it, and it helps us get better with every single episode. We'll talk to you soon.